Okay, good morning, and welcome everyone to the Markets Insight call. My name is Jackie Runberg, and I'd like to thank all of you for joining us today. We have two members of our investment team to discuss a look at key trends shaping the domestic and global economies and review market conditions. We have Steve Mavis, he's our Chief Investment Officer, and he'll provide market review, a review of our investment strategies, as well as a discussion on the economy. We also have Brad Johnson joining us. He is a Senior Investment Officer, and he will be reviewing the equity markets. At the end of the presentation, we will open up for questions. If you look at the top of your screen, you'll see where it says Q&A, and that is where you'll be able to type in any questions that you have for our investment team. And with that, I'm going to let Steve begin.
Good morning, everybody. I'm going to start off this morning with a brief market review, touch on our strategy performance, and then I'm going to turn it over to Brad. He's going to go into some of the market conditions that exist and how they're impacting the equity markets. And then, unfortunately, our lead fixed income portfolio manager is not with us today, so I'll be stepping in and just touching briefly on the current rate environment and some of the opportunities that exist in the fixed income space. And then we'll wrap up with the economy and the impact of some of the slowdown that we've seen as a result of the shutdown and other job softness in the market. With that, real quickly going through our equity strategies and fixed income strategies on a quarter to date perspective, outperforming all respective indexes for each of the strategies. Notable is on the first strategy listed here, diversified equity. 1 year performance, and these are all net of fee numbers, slightly below our target index. And that's largely as a result of what we saw with the tariff impact and international markets rally coming off of that. So I will touch on what drove some of that, and it's nice to see that we're already starting to see recovery on that. Also, I wanted to note, if you're not subscribing to any of our newsletters, we do provide a weekly update and a monthly update, so I would encourage you to reach out to your advisor, get put on the list, and you'll be able to stay in tune with what we're seeing in the marketplace. Looking through the market over the last year, all markets have been strong. The S&P 500 up over 14%. And then I had mentioned international markets, which is represented by the MSCI EAFE, up 24%. Coincidentally, that difference, that 10% difference, is entirely a currency differential. The US dollar has pulled back pretty significantly since the beginning of the year, and that largely has resulted in international stocks looking pretty attractive from an investment perspective. You will also note on a year-to-date basis, all the major categories are positive, and they're positive pretty strongly. Even in fixed income, up 6.1% year-to-date. And so from that perspective, diversification has worked. We preach it over and over. If you don't have a plan in place, certainly reach out with your investment advisor. We can put a plan in place for you. We'll put a strategy that works for you, and you can participate in some of these digital double-digit returns. And then last, before I turn it over, I did want to touch on the government shutdown. I think a lot of people are concerned about it, rightfully so, and especially if it's impacting you directly. The important thing from an economic and a market perspective that we're looking at is how much is that shutdown impacting stocks and the underlying economy. And so starting with the economy, we look at total government spending, and you'll see that it's about 17% of total GDP. Within that, the shutdown is specifically federal, number one. And so the federal is only about a third of all government spending. And then the second part as it's represented in GDP. And then the second part is it's non-essential jobs that are not being paid. There are furloughed employees that are essential employees. They're still doing work from home. They're going to be paid for that. And we will see that reflected possibly at a later date in GDP numbers. So with that, I'm going to turn it over to Brad. He's going to touch on the equity markets.
Thanks, Steve. So the rally that we've seen off the post-Liberation Day lows has been relatively unloved and has come in the backdrop of some pretty low consumer confidence out there, indicating to us that sentiment is not yet a risk for this rally ending, which is definitely a positive. As we've seen throughout history, these surveys and soft data can sometimes be contrarian indicators for stock market performance. As we've seen over the last 9 sentiment troughs in the survey data have generated an average one-year return going forward of 24.1%, as opposed to some of the more euphoric times when sentiment is high, generating below average one-year returns at 3.9%. In the current conditions right now, where respondents are responding to these surveys based on their political affiliations as opposed to an actual financial assessment or an actual accounting of their buying power, we can continue to see this dynamic take place, and we've seen that off of those April lows. So now with the market rallying quite a bit here so far year to date, there have been some pundits drawing some parallels to the market environment of the 1999 kind of dot-com bubbling up period. But it's important to note that the foundation of stock market returns, which are corporate earnings, have been growing pretty strongly and have grown over 10.2% so far year to date and are projected to grow in the mid-teens for 2026 and 2027. Now, we've gotten there with in line with historical averages revenue growth of 4.7%, but it's really been that margin expansion that we've seen that's contributed 6.3% of the 10.2% of EPS growth, as companies have been harnessing a lot of productivity gains and are executing very well, which has led to a 13.6% overall profit margin for the index, which is near the peak since the turn of the century. So while the market has broadened out, as Steve alluded to, with international markets performing very well, the Russell 2000 small cap index hitting a new high for the first time in the decade, it has been the top 10 names in the S&P 500 that have driven a lot of the market's gains, as well as commanding a continued premium multiple valuation over the rest of the index. Now, this valuation might be justified, as we talked about last quarter, as most of these companies have very asset-light capital structures, which could command that higher valuation justifiably. But what we are seeing now is an extreme concentration in those top 10 names, where they now represent 40.5% of the S&P 500 index, while contributing 32.5% of the index's earnings. Now, this relationship between earnings and market cap does have ebb and flows. We've seen over the last 30 years, oftentimes the earnings start to catch up to that valuation, but it's not time to be complacent and just rely solely on those top 10 names, because as we'll see on the next chart here, those top 10 names do change pretty wildly over the course of the long term. So what we've got here is the top 10 names going back to 1985 and each decade going forward, as well as how big of a concentration those 10 names contributed. So certainly the 40% that the top 10 names contribute now to the S&P 500 certainly dwarfs what we've seen in history. The message here is that these dynamics do change, and some of yesterday's winners drop off the list. And so taking some gains potentially in some of those top 10 names right now, if they represent a concentrated portion of your portfolio, may be the prudent move, even if it does come with it a capital gains tax. Because as we've seen throughout history, the previous decades behemoths such as IBM and GE were perhaps held on to too long by investors and then have kind of dropped out of relevancy as time goes on. Circling back to the global equity markets, as Steve alluded to, that drop in the dollar versus the primarily developed international currencies that has stabilized but has not reversed, which has led to some pretty strong returns for those markets in both local as well as US dollar-based returns. For example, the Eurozone up 19.5% when priced in euros, but 33.3% when translated back into dollars. Now, the exception to that has been the emerging markets, which has not experienced much of a currency tailwind. And particularly China is up 36.5% on a local basis and only 36.9% on a US dollar basis. Now, breaking down the components of total return into the categories of earnings, dividends, currency fluctuations, as well as multiple valuations. Over the longer term, looking at that 15-year portion on the left-hand side, typically we see a good mix of those components working in tandem to generate those longer-term returns in both domestic as well as international markets. What's been interesting is so far year to date, over on the right-hand side, we've seen some kind of skews on some of those other categories. In particularly China, with its 36.9% year-to-date return, has not had their companies grow their earnings one bit. The rally has been purely from valuation multiples being attributed to that, which is something to be aware of. Now, the Eurozone has improved their earnings situation a bit in that dark blue contribution, but the vast majority of their gains so far this year have come from multiple expansion as well as that currency effect. Now, they were coming into this year with very low valuations, so some of that valuation expansion certainly could be justified as prospects improve, but again, something to be aware of. Now, whereas the US, for all of the hand-wringing about a potential bubble, the 14.3% return thus far this year has the majority of it being contributed to by earnings growth, with a little bit of a kicker from the multiple expansion there. So circling back to the government shutdown and how it affects the equity markets, just for some historical context, we have seen 21 previous government shutdowns, with the last one prior to this being in December of 2018. The average duration of those shutdowns has been 8 days, with the longest being 34 days. So currently, at 14 or 15 days right now, we're above average there, but below the longest that we have seen. Looking at stock market performance in the lead up as well as after the government shutdowns occur, what we've seen leading up to it is relatively flat markets, a little bit of chop there. But once a resolution is reached, we've actually seen some pretty outsized returns in those 100 days after the government shutdown. So there is some room for optimism despite the government being closed. And then finally, during the shutdowns themselves, what we've seen is during those time periods, 12 out of the 21 government shutdowns have generated positive S&P 500 returns, with an average return of a relatively negligible 0.1%. So the story is here, despite some of the narratives going around, the government shutdown is not a market moving event. With that, I'll pass it back to Steve for the fixed income markets.
Thank you, Brad. And I'll do my best I can on the fixed income markets without our lead. But I will start off with the yield curve and where we've come over the last 2 years. You recall when the government, the Fed was in a mode of increasing rates, we got what's called an inversion, and that's when our shorter term interest rates, and that's the green line here, are significantly higher than our longer term rates. And they typically will look at a 2-year versus a 10-year. And if they're upside down, as we saw with that green line, there's bears that will say, well, that's an indicator of, an impending recession and a market downturn. Well, we didn't see that. Here we are 2 days later. And I think the saying goes something like inversions predict 13 of the last 5 recessions. So it's just not a good indicator. It proves itself again. More importantly, I think where you look how this yield curve looks from a year ago, we still really had not made any movement on the short end of the curve, but longer term rates came up pretty significantly. We were certainly in the camp of advising you to take advantage of that. As rates have come down, that's been beneficial to the fixed income market. And we still see what we call a saddle right here. Short-term rates still remain a little bit too high. And we do anticipate that there's going to be future Fed cuts that are going to normalize this curve. Don't really have a great perspective on, do we anticipate rates on the long-term side to go up or down? We do feel pretty comfortable with where we're at. We're in a mid-range, and we could see some increase depending on if there's stress in the markets on some of these longer-term rates. But with the Fed easing right now and some of the other economic activity that we've seen, we are pretty optimistic about what the opportunities provide us, both in the equity markets and the fixed income markets. I mentioned that the Fed is probably a little slow in the past, and that's proven right here. You look at the Eurozone, you look at our neighbors to the north, Canada, from their total Fed tightening, over this rate cycle, you see that they've already recaptured 52% of their total rate tightening, which for the Eurozone was 4.5%, for Canada, 4.75%. Our own was 5.25%. Our easing has only been down about 1.25%. And so even if we get the 2 Fed rate cuts scheduled for the end of the year, this number will still only be 33% of the tightening action that we saw from the Fed coming out of 2021. In the Fed policy and the projections, we can see on the right-hand side of this chart, the Fed is projecting, without a doubt, by the end of the year, that there should be 2 rate cuts. The market, looking into next year, is a little bit more aggressive, though, than the Fed. The Fed is looking to maybe 1 more rate cut in 2026 based on the current projections, and then maybe towards the end of 2026. Whereas you see the market is generally a little bit more aggressive on what the Fed should be doing. Despite this, income generated from the fixed income asset classes remains quite attractive. You see the yields on a historic basis in that purple line, and the range of returns. We're certainly in a higher end of a yield range. And so it certainly is a good time when you start talking about diversification, thinking about the contribution you can get from that fixed income portion of your asset allocation, to be incorporating that into your overall investment solution. Moreover, if you look at, and jump ahead a little bit, if you look at the dynamics of where the current interest rate environment is, what we have on the right-hand side is what would happen if there's a 1% increase in rates or a 1% decrease in rates. And the left-hand side is kind of that negative outcome if we have a 1% increase in interest rates. Whereas if there's further reduction in interest rates, you can see there's positive outcomes in all of the asset classes. And more importantly, the skew that we see to the positive side for a respective 1% change. Now the question then, what's more likely, a 1% increase or a 1% decrease? Well, on the short end of the curve, and when you start looking at some of these shorter term treasuries, there are some positive outlook potentially, as you go 2 years and in, going back to the saddle that we mentioned right here, right? And then last, one thing I wanted to touch on the income yields globally. Big difference in the U.S. The U.S. a year ago, December of 2024, the aggregate market was 4.91% yield. That's come down to 4.25%. And you look globally, a year ago, it's about the same. And so as I move into the economic outlook, start thinking about, hey, if you're a foreign investor and on a relative basis, this has dropped, 12% year over year, well, not quite year over year, but over the last 10 months, whereas the international yields have largely stayed intact, with the exception of Canada. You see Japan has actually increased. China has also increased. And so you would anticipate that maybe some of those or currency, in the foreign economies, Germany 2.7 down to 2.66, are more inclined to stay locally. On the economic front, I do want to touch on that composition of GDP. It's so important to remind ourselves that the majority of the GDP growth and GDP contribution is coming from what you and I spend. It's the consumption. And the federal government is only 6% of that total contribution to GDP, while state and local government are even in excess of the federal government at almost 11%. And then I will note, because I'm going to touch on this, the investment, non-housing investment. That's what we look at, on the corporate front, and what are companies doing as it relates to investments. GDP growth, as I mentioned, the consumer and that consumption is a majority contributor historically over the last 24 years. And even today, the second quarter, we saw that the consumption represents about 70% of the total GDP. Now, there was a little bit of sway from the first quarter to the second quarter, and that was the exports and imports, right? And so there was, with posturing that we were going to increase tariffs and what have you, producers certainly brought in process and raw material goods in preparation of that, and to avoid any impact that it might have on their bottom line. And then we saw them burn through some of that, during the second quarter, where you see their inventories decrease pretty significantly. And then the import actually impact to total GDP last quarter. Now, really what's more important and what we look at, and this is going to be two issues. First of all, the Fed, are they going to cut? Do they need to cut? Well, I would say yes, and here's why. Number one, they have a dual mandate. One is to control inflation, right? And so on the inflation front, we do believe that's in check. We believe that's in check because what really drives inflation is money in the pockets of the consumers. And so if we look at the chart on the left and we look at wage growth, we can see that wage growth has certainly come down from a high of 5.5%, back in 2023, down to under 3%, 3.5% right now. And then in the red, what's plotted here is a quits index. And that's the number of people that willingly leave their jobs. Well, why do you leave your job? You leave your job because you can get paid more somewhere else. Well, wage rates are coming down. So we tend to see that lag by about 6 months. And that's certainly the expectation for that quits rate, is to continue to stay low because the wages are coming down. And then secondly is the availability of jobs. And so on the right-hand side, what we see is easy to get jobs versus the harder to get job environment. And we've certainly been trending down over the last year and a half. And so with that, we're seeing quits numbers come down, unemployment rate coming up just a little bit, and it's not at a high rate, but it's something to take note of. So we don't believe inflation is an issue, and we do see some softness in the jobs market and the labor market. And so the Fed is certainly timing it right now well if they're moving forward. And frankly, they may be a little bit late, but we'll see. I think there's some catalysts that exist in the one big beautiful bill that was passed that we should see in the first quarter of 2026, and that should be stimulative to the economy. And then the last thing, we talked a lot about the dollar, and there's some elements within the market that are worth mentioning. One of those is gold, and I'll touch on that real briefly, but it stems around this uncertainty of policy changes. Not only does it impact what we do locally, but it impacts what foreign governments do. And when there's uncertainty of where the U.S. is as far as leadership as it relates to the global economy, and from a political perspective, they start chasing gold. They're putting more and more gold in their reserves. The domestic or the developed economies are less inclined to be selling the gold that they have in hand. And so what you do is you get a dislocation of supply and demand. And we've seen that gold has rallied almost 100% over the last 2 years, 55% year to date. And usually what we see is gold is not a good investment. I would still argue it's not a good investment. It's been a great speculative play over the last 6 months. And if you had some, good for you. If you're looking to get some, I'd caution you, and here's why. When you look at when both gold and when the S&P 500 are in the 90th percentile on a 6-month performance, the S&P does all right 20 days out, gold not so much. 65 days out, the S&P 6.6% up, gold about 6.2% down. And a half a year out, S&P up 10.3%, gold down about 10%. So if you're looking at gold, just be cautious right now. Understand what's driving it, and it really is a supply and demand. It's speculative at this point, and certainly would advise against that. And then last, that US dollar, right? I mentioned a little bit on uncertainty on policy. The second part of it was interest rates abroad have largely remained intact on the broader fixed income markets. And so when you see that 10% drop that we saw in the US dollar relative to foreign currency was reflective in US returns relative to developed market returns. But moreover, there's not a trend here in de-dollarization. And if you read the press, you're certainly going to see plenty of articles around that. But look over the last 10 years, we're well within a normal range of where the US dollar is traded. And so this is a short-term effect, and it's based off of a couple of things. Part of it is policy. The other part of it is, hey, can I make a little bit more money in my own domestic markets if I'm in Germany, if I'm in Europe? And then the last point, artificial intelligence, you hear about it. If you don't know what it is, certainly read about it. It's being incorporated into every industry. On the right side, you see what industries, what sectors have spent on AI over the 2023 time period into June of 2025, and the projection over the next 6 months. And so there's just been a significant investment into it, and notably by the hyperscalers. We see how much that they've increased already, and the projection for them to put another $1 trillion over the next 3 years into AI investment. It's going to be a significant catalyst if this proves to be true for the US economy. And that's going to flow through to investors. It's going to flow through to the jobs market. And that should prove to be quite strong for the US economy as we move forward. And with that, I'll open it up to questions.
Right. So we have a question already. How will the new China export restrictions impact the markets?
Well, let's see if they're actually put in place. The deadline's November 1st. There's a note that Trump always chickens out, taco, if you've not heard of it. I think what he really does, he does a lot of posturing, right? He wants to make it very clear that you're not keeping up your end of the deal. And if you continue down this path, we're going to revert back to where we were in April. And that's largely what I believe is happening. There's been, behind the scenes discussions going on between the US and China. And I do anticipate they'll resolve this. But we'll see. Right? I think largely we've been through this in 2016 through 2020. We've seen a lot of posturing out of the current administration, and Trump 1.0 and Trump 2.0 is proving to be very little different.
Excellent. Next question. Do you anticipate liquidity to continue to flow into equities, particularly expanding market breadth and extending this rally?
You want to take that, Brad?
Yeah, sure. Yeah, no, I can take that. I don't see really any reason why it would be cut off. The Fed is, embarking on an easing cycle. We do have, as mentioned with the Big Beautiful Bill Act, some nice positive tailwinds, particularly for the consumer, coming into early 2026. It'll be a big year for America. We'll see what the impact is, but I think there's just going to be a push to keep things rolling, so to speak, with the 250th anniversary of the country coming up next year, as well as the World Cup. That's getting a lot of traction in terms of consumer spending and dollars that could be flowing in, and that should kind of keep the train rolling as long as companies are continuing to improve their earnings and their profitability. I would not see any reason why the liquidity picture would be a hindrance to that.
I have another question that was submitted prior to this, and it was, can emerging markets stay resilient amid global rate shifts?
I do believe emerging markets provide a unique opportunity when you look, and I think China is got, some issues of how they position themselves and their desire to be at the top of the world, at the forefront of everything that is happening, has put them in a peculiar situation. But I would look at India. If you look at the demographics in India, they're a little bit better than what they are in China, actually quite a bit better than what they are in China. And I do believe India has significant investment as they move forward into their, into their infrastructure. I go back in my own career and I covered international managers, asked the same question probably 20 years ago, where do you see India? And the manager at the time for one of the top international funds in the country said India is about 20 years behind. So I do anticipate that continues to be a good opportunity. We have, we moved our toe in the water to a foot in the water. We like that from a longer term investment opportunity. It's worked out well for us when we did it in China. And so I think there's going to continue to be opportunities. But you have to be measured about it. You have to be smart about it. And then, as Brad mentioned, some of the stimulus that exists for U.S. companies to be investing locally, there's still a lot of opportunity locally as well.
Perfect. We have another question. Are you concerned about the AI bubble? About an AI bubble, sorry.
I'll take that because I see Brad is muted right now.
Nope.
Cautious about an AI bubble. I think we collectively as a society don't understand exactly what this means, and we're trying to vet it out. I was at a conference yesterday where somebody was talking about one of the people that they interviewed, and they put the job description into AI, they put their resume into AI, and then they put some scenarios about the company, and it generated 10 expected questions that they would have in an interview, and the person found that 6 of the 10 questions that were on his list were actually asked in the interview, and they were prepared to answer them. So it's a great tool. It makes us more efficient. It makes us more productive. And that's how it needs to be looked at. Is it a bubble? I don't think so. I'm cautious about the amount that's being invested, and it proves out not to be profitable. But I do also see it as a great tool to increase efficiency and increase productivity, and make things a lot easier.
We have one additional question. As a real economy, GDP, employment, et cetera, softens, what is the risk of overvalue of the U.S. equity markets and potential for a meaningful market adjustment?
I can field that one. So yeah, we've certainly seen, the employment picture, soften a bit. A lot of that is likely due to immigration policy. So it just doesn't take as many jobs to be created to keep that unemployment rate relatively stable. We have seen it tick up a little bit, and jobs certainly drive the economy, but there are offsets, both on the fiscal side as well as monetary easing coming in as well. GDP is still chugging along at around a 3% rate, which for as developed of an economy as we have is pretty solid. Certainly, if we see any of those dynamics meaningfully weaken, we could see more of a nefarious market adjustment. But even if we see a 5-10% correction, that wouldn't necessarily sound off the alarm bells of recession. It's just kind of normal market dynamics, and we average a 10% correction once a year. Basically, and we had ours this year around that Liberation Day event when we saw the market actually pull back near 20%. So not to say guarantee any returns or anything like that, but the market's on pretty solid footing as it stands right now, with some good things coming down the pipe.
Perfect. Well, it is 11:38, so we will wrap things up. Just to let everyone know, a recording of the session will be made available within a few days on our website. As Steve had mentioned earlier, anyone that is interested in receiving the weekly market update or the monthly market update, please reach out to a member of the wealth management team. I want to thank you again for joining us. And our next Market Insight webinar will be in January, and we'll take a look back at 2025 and a look forward to 2026. Thank you again. Have a great day.
Take care. Thank you.